Well, joining me now from Albuquerque, New Mexico is Michele Schneider. She's a chief strategist at MarketGauge. Michele, it's great to have you on the show today to get your expertise in what has been a choppy market. What can you tell us in terms of how you're looking at this particular environment?
Well, first off, good morning, Kristen. Great to see you. Well, obviously, when we have rallies like we had yesterday, this is not so atypical in a bearish market. And the market was waiting for some good news, and the 90-day moratorium was enough. But what I'm really thinking about this market now, as opposed to other times when we've had major crashes, or I should say corrections, is that those were more one issue, right? So 87, actually, no one really knows what happened then. But then we had the dot-com, we had the financial crisis, we had the government shutdown in 2011, then we had the taper tantrum in 2018, and then finally COVID. Those were, you could single that out. But right now, tariffs were more the catalyst to a lot of other surface problems that we have with debt, with geopolitics, with a dollar potentially crashing. And so that's just a few. Consumers, of course, being nervous about many things, inflation and recession. So how things sort out, I think we're a little bit far away from saying bottoms in, jump in the water for long-term position.
Michele, certainly, I think, as you mentioned there, the markets were ready for some good news as the S&P was looking at a bear market in the start of yesterday's session. In terms of the bond market, we've seen a lot of action happening there with yields as well. Give our viewers a sense as to what is going on and why this particular movement is not necessarily typical.
Well, first of all, usually you have bonds as a flight to safety, right? Particularly long bonds, but that has not been the flight to safety. And in fact, even when the market was going down, yields were rising. That's highly unusual. So there's some theories about that. I mean, obviously, there's also a fear of a debt crisis. We can add that to the mix in that foreign governments, especially China, may not be buying our debt, selling our dollar, and trying to shore up relationships outside of the United States in case things get dicier with tariffs. And so that's why the yields right now are not moving. And also the Fed has been very clear to date that they're still more concerned about the impacts to tariffs and inflation than they are right now about recession. So that would have to shift as well. We'd have to see Powell come out and say, listen, we're ready to lower rates if we have to. And that may not even be such good news, because that could mean they're now scared, and that spooks the market even more.
Interesting. Michele, we did see inflation come in a little bit less than expected, but still above the Fed's 2% target in the report for March for consumers out earlier this morning. Does that shed any light in terms of the state of the consumer and thus the economy?
Well, there was a lot of buying ahead of tariffs, and so that might have been one reason why inventory was a lot less. But airline fares were the biggest part of the drop in CPI, and that's another issue in and of itself. Not so much that it costs less to go flying, but that we're seeing a decline in tourism, and tourism is 9% of the GDP. So as far as the CPI, I don't think it's necessarily going to predict what could happen. And of course, that's the big unknown. What will happen to the price of goods? China, for example, they export to us double of what we export to them. And there's a lot of threats going on now between the US and China, and consumers are watching, considering how much cheap goods we've gotten used to buy over the last several years.
Mm-hmm. Now, in terms of the uncertainty that needs to get resolved, Michele, is there any sort of timeline that you're looking at for some of these items perhaps to get checked off the list for us to get a little bit more clarity that could change your investment thesis?
Well, it is possible that by the time we get to June, things might relax. And that could be for many reasons. We could possibly come to some kind of agreement with China. The tariffs on the other countries, obviously now we're hearing that they want to talk about relaxing their tariffs to us. We could see, obviously, some kind of confidence in the fact that we're not going into a free-falling recession or even much higher inflation. The consumer, I think, is going to be the key here, Kristen. You have to watch that consumer sector. We like to look at it through XRT. very specifically because that's a nice blend of staples and discretionary. And it was the first really to turn down in January, even before tariffs, because of all these other issues we mentioned. And it'll have to be the place to look for a sense of calm, because that will tell us now that people are not looking for the worst case scenario, but saying, okay, things aren't so bad.
So in terms of what the XRT is telling you in the state of the consumer, Michele, what more light can you shed there?
Well, let's, I like to look at monthly charts because that gives you the best view if you stand back. And what happened with XRT after it started to sell off is it broke, first of all, a 2-year business cycle low, which tells me that immediately that was showing contraction, and that's obvious right now. But then there's a longer term moving average, and that would be like a 5 to 6 year business cycle. And what makes that so relevant is that we have not been under it. And we were under it for like a minute during COVID, but it came right back. So we have not really broken down under that line. And if we do, that is a real sign of recession. And then I think we have problems all around. So we need to hold around if we want to put numbers on it. 64 is a big number to hold. We can get through 72, then I think things will look a lot more roseate.
Michele Schneider, Chief Strategist at MarketGauge, joining us from New Mexico. Michele, always good to see you. Thank you.
Nice to see you.